the Monetary Policy Committee with Reserve Bank of India unanimously decided to maintain a status quo on interest rates. This was largely in line with our expectations, and markets also seem to have discounted this announcement. The key thing, however, is that the accommodative bias has been maintained, which is in a way good thing because intuitively so, given the high headline CPI numbers, it would have been a conundrum for RBI to be forward looking and maybe do insurance rate cuts. So the accommodative bias removes the ambiguity from the minds of the market participants if or not there would be further rate cuts. So I think that's definitely a very good positive. The other very important thing which I think is relevant from market standpoint is the long-term repo operations or the LTRO. I think this is a master stroke by Reserve Bank of India, wherein they have announced up to 1 lakh crore of liquidity on a 1 year and 3 year basis as repo to the banking sector. Now this is demonstrating the Reserve Bank of India's intent towards credit transmission, which was a big challenge and one of the key impediments to India's growth trajectory. So a combination of maintaining an accommodative bias, introduction of LTRO, and there have been exemptions on CRR, which is cash reserve ratio maintenance, for certain sectors like auto, MSME, and residential real estate. Now, each and every of these measures combined, we remain convinced that the path to monetary transmission, which was very sporadic, is likely to happen slightly en masse. Markets have certainly cheered these announcements, and we believe a combination of what we saw on the day of budget and what we have seen through the monetary policy guidance would be strong anchors for bond yields going forward. Is this growth positive? Certainly yes, albeit with a lag. As and when this liquidity flows into the real sector, the pockets of revival which were being expected is likely to fructify sooner than later. It's also important to note that the RBI has lowered the guidance for inflation towards Q3 of financial year 2021, which effectively tells you that the gradual glide path of inflation, if that were to materialize, maybe with a couple of more pauses, we could see the rate easing process. We need to be mindful, however, that 2020 may not see the same quantum of rate cuts as we saw in 2019. From a fixed income standpoint, this bodes well for the investor fraternity, where we believe, depending on your risk appetite and your investment tenure, there is a category of fixed income to suit all your needs. Thank you.